If you're retired or even just getting close and you're planning on pulling income from your investments, I'm asking you to please not skip this step. Now, I've seen smart, careful people be unpleasantly surprised because they didn't understand or follow this one piece of their plan. And during the COVID crash in 2020, this exact strategy is what separated the folks who recovered quickly from the ones who panicked and sold at the worst possible time. Hi, I'm Jordan Lehman, founder and financial planner at True Wealth Retirement Partners. And every day I'm helping my clients create steady retirement income, invest smarter, pay less in taxes. And I want to share what's working for them so that you can retire with confidence too. So today I want to walk you through what this step is and why it matters, especially when you're taking income, and show you exactly how it played out in the real world during the COVID market crash. So let's start with a simple question. What is rebalancing? Because a lot of people have heard the term, but very few actually know how powerful it is in my experience. Rebalancing is the process of resetting your portfolio back to your original mix of investments. For example, let's say you've decided on a 60% stocks and 40% bonds portfolio, just generally. That's your plan. But then the market drops and stocks fall faster than bonds. So now your mix is closer to instead 50% stocks and 50% bonds. Rebalancing means you sell a little of what held up well, like the bonds, and buy more of what dropped, like the stocks, to bring things back to the 60/40 target. And yeah, that means you're buying the stocks during a market crash. And I know it sounds a little counterintuitive, maybe even risky, but here's the thing: rebalancing, and this is critical, doesn't require you to predict anything. You're not going to try to guess the bottom. You're not watching CNBC and reacting emotionally. You're just following a consistent system. And the system works because if and when markets recover, as they always have historically, you're positioned to benefit from the recovery. No crystal ball, just discipline. Now, this is where rebalancing goes from just smart to absolutely essential, in my opinion. If you're still working and not relying on your investments for income yet, rebalancing helps you stay on track. But once you're retired and actually pulling money from your portfolio, rebalancing can be the difference between long term stability and running into some serious trouble. Here's why. Imagine the market drops, say, 20%. Okay? Think about a month ago, you don't have to imagine. And your stocks take the brunt of the hit. And if you keep withdrawing income from your stock holdings during the drop, because that's where your money usually comes from, you're not just watching now numbers fall on a screen, you're actually selling those shares at a loss. And that turns what could have been a temporary dip into a permanent setback. You're locking in those losses. But if you've been rebalancing all along, there's a good chance your bond or cash allocations are still holding. So instead of pulling income from the part of your portfolio that's hurting, you draw from the part that stayed strong, which gives your stocks time to recover without forcing you to sell them at their lowest. And over time, that's what helps your portfolio stay resilient because you're systematically selling high and buying low, avoiding the trap of locking in losses when markets get rough. Let me put this another way. Here's a quick do this, not that. Do this. Rebalance regularly so you always have something to draw income from when markets are rocky. Don't do this. Just ride it out blindly or hope that everything works out. Hope just isn't a plan. So let's jump in and look at the COVID scenario. So this is a case study from COVID. If we look at this, this is the month end return at the beginning of 2020, turbulent times. So we look at January. These are three indexes, by the way. The Russell 2500 is an approximate index of the overall US stock market. The MSCI EFI Growth, an index of international stock markets. And the Bloomberg Aggregate 1 to 5, a kind of general shorter term bond index. Okay. Well, how did these three indexes perform? And let's say an investor has a portfolio that's kind of diversified between these three indexes or asset classes. So in January, US stocks saw a 2% decline, international down just over a 0.5%, and their short term bonds up just a little bit. Okay. Now things start getting hairy. February, US stocks down 8%, international stocks down 8%, and short term bonds up just a hair. Okay. March, things get ugly fast. Now we have a monthly return for US stocks of negative 21%, international stocks down 9%, and short term bonds start feeling the pressure down 0.75%. So step back. Someone whose portfolio, let's even say, was evenly spread between these three asset classes now suddenly has much more as a percent of the whole in bonds because that portion of the portfolio was relatively flat. International stocks saw a moderate pullback, and US stocks saw a significant pullback. So, what does rebalancing say we should do? Well, I think it says to do the exact opposite of what we would tend to want to do. Get this, you see this kind of a decline in your US stocks. What is the average investor's temptation? To sell what's not performing, to buy what is performing. The problem, that's the exact opposite of rebalancing. You're locking in your losses and buying what's high relative to the rest of the portfolio. What does rebalancing say you should do? Well, rebalancing says, hey, we've got a big chunk of money here in our fixed income or bonds that stayed relatively steady. We're now, because of the market drop, underweighted in both US and international stocks compared to our target. So here's what we'll do. We're going to sell some of these bonds. Thank goodness we had them because it gives us an opportunity to buy US and international stocks at a what? Significant discount to what their market price was. Okay. Now, what do we see happen in the months following? Was rebalancing rewarded in this case? Well, in April, then, your US stocks up 14.5, May 7, June 2, international, a little bit more muted, but a similar type of recovery relative to its downturn. So the investor that rebalanced actually strategically improved, in a sense, their returns because they had the opportunity to purchase and right-size their portfolio when stocks were down. Completely different from what the average investor wants, which is take me to cash, take me out of the market. I'm waiting until things get steady. That's predictions, not a system. And by the way, if you don't currently have that kind of system in place, or you're not sure if your income plan would hold up under that kind of market stress, I would love to help. So there's a link in the description. Schedule a call with me. Would love to chat. Here's the bottom line. Rebalancing isn't flashy. It's not exciting, but it is one of the most powerful tools you have to protect your retirement. And it could be the difference between a portfolio that runs out of gas and one that gives you freedom for decades. Thanks for watching.